Hi, this is Bill Foote, and this is System Dynamics from a Bayesian Decision Analytics point of view, and we're at week 7 out of 7. We're nearing the end of our rope, not the bitter end, the sweet end for sure. It's been quite a bit of difficult material that we've covered, and here is probably awfully close to the last spreadsheet model I'd like to share with you. And as you can see, it's the predator prey WolfCo MooseCo challenge where they're competing with one another for a set, and that's the yellow line, set market of potential customers. And of course, that declines over time in this particular scenario. But now we have price involved. And price is involved in a very almost naive way. It's a first approximation. What we're doing is we will be taking, let's go with the Venson model. We'll be taking numbers of Moose customers, numbers of Wolf customers, and multiplying the customer times some metric, which will allow us to say per customer how many units did they buy at a particular point in time. Now, the time we have is 0.002 of a month. The step size very, very small. So how many things can a single customer buy? Oh, say at Target or at some other big box store, or down Crosby Avenue at AT&T. Probably not much in a couple of minutes. Who knows? And so where's the competition? The competition is probably not even inside of this except for the interaction. So if we take these numbers of customers and multiply them times the number of items purchased by the customer per unit of time. Now let's say the unit of time is 1 month. We will have to have a time to adjust that's equivalent to the time step that we have chosen, which in this case is 2 thousandths of a month. Go figure that out in terms of how many minutes that might be. But we have to be a little bit careful here. We're doing a very big simulation, probably bigger than what we need to do. 12,000 simulated points across a 24-month period divided up very, 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 very finely. But that's the idea here. Take these numbers and now make them into demand numbers. And the simulation will show you exactly what's going on there. This is the same as the pricing supply-demand model that we have perhaps seen before. Let me see if I can pull that up. This is the model. So now we're reeling around in price, but demand now depends upon both WolfCo and MooseCo customers as we meander through time in their competition and their interaction with one another. And the demand is equal to how many customers times how many items per customer. And that'll be the demand. The supply is fixed in the sense of being exogenously given in this model. We would probably want to have some sort of procurement activity, supply chain, perhaps an inventory on the side to feed the supply. That would be, like I said, this is a first approximation. And that would give us a reference supply. There's an elasticity of supply relative to price. That's what that arrow coming in there from price is. Just as there's an elasticity of demand with respect to price, that's this arrow right here. And so we have this world going around here in a couple of loops. There's of course the reference loop here, which allows this accumulator to occur, the state of the world for price. And what makes this work, though, is the supply-demand balance, just like before. Okay, so nothing new there. Nothing new there. But what I've done here in this model is simply brought this simulation, as you can see, it's a lot easier to do here, this simulation into this WolfCo model. Okay, so demand affects price, and the relationship between supply and demand is now dependent upon not only price as it comes around and comes around, but also on other information. And the other information has to do with the competitive relationship between MooseCo and WolfCo. I'm hesitant to call this a rational expectations equilibrium, but it's awfully close in spirit to this. Somebody might say, well, it's just an adaptive expectations. Yes and no. We're not just adapting to the previous price. We're adapting to the previous price and the entire history of Moose and WolfCo relationships. In this case, predator-prey, as well as the history of past customer availability, the potential market. So that's pretty much what we're after, in spirit at least, in a rational expectations environment where the model price is, which is the expected price, is equal to the price that we might come up with in the marketplace, and then they're equalized here. Going back again to Muth, Econometrica, 1961, and David Newberry and Joseph Stiglitz, who built upon that. But again, we're taking into account history, all the information available today, at whatever step we are in the simulation, and using that information to update what we're doing here. And in that sense, it's also very Bayesian. The simulation is one Bayesian realization where we're taking prior information, running it through a model, a way of thinking about how to use that information in a marketplace, and then a posteriori, coming up with an updating. So there's that whole schema of thinking, and everything runs back and forth. Now, what is not happening here, which could well happen someday, maybe in week 8, if I forget there. No, that's after the course is done, is somehow bring price back into this fold. So potential markets, the potential customer base might be the thing that will take the aggregate price, that's a market price. These are really just sub-markets here, 2 sub-markets. One supply, 2 different demand markets, makes a very interesting situation right there. But bring that back into the customer base here and have a customer sensitivity to price worked into the customer flow. And that would be my proposal. Don't know if that's going to work, because in these models, who would have anticipated this kind of shenanigans, right? Go to the graphs here. All sorts of interesting things are happening here. And let's see if we can put an interesting thing here. No, nothing's happening there. Go up here, fire that away. There we go. Nope, we have a little bit more bump. I did one of these where we had a total curly Q here because we had a very significant path of wolf uh, 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 wolf moose relationship here. This hump right here is very, very pronounced, much like in the original model. Now remember, the reason why this model works this way and dampens is because there is a limit to capacity here. There's a finitude worked into this model. But down here, we see what we should be seeing with price and demand and supply. If we have a disequilibrium where demand exceeds supply, and that's over here on this axis actually, supply is at 600 and demand is at 640, we see an immediate drop, just as Sterman predicted, and then a gradual increase in supply and decrease in demand. Now this also assumes that there is a supply available, which is another limit to capacity in this market. But be that as it may, what happens as we get the equilibration of supply and demand, as market clearing struggles here, each round we're struggling to clear the market. We don't actually clear the market until quite a few months in this particular arrangement here, where we get these two, the red and the yellow line. Let's see, put a legend here. Let's see if I can take the bottom up over my face. There we go. That's much better. So we have price, supply, and demand. And these two come together, and this is how how it should work out. Common sense tells you that that's what's going to clear it if you truly believe that supply and demand depend upon price. Demand negatively depends upon the price. Supply positively depends upon price. And if we were to build a graph at this point, which I'm hesitant to do, but I will try anyways. Let's see, my track record with building graphs in front of you has not been terrifically good, but I'm going to try anyways. Okay, just a simple line graph here. We're going to select two data streams. I'm going to add a demand curve. Now this is not over time. This will be relative to price, where we're going to have x values equal to, in the simulation, demand. Okay, that's the U column. And y values will be the price. Now, I'm using an indexing with price. I don't know what the price of these things are. I don't even know what these things are, and we haven't even specified that. So it's just a little math game we're playing. But this is a pure index at this point. You see, it goes up to a whole 108. It's like the consumer price index over time. And so there is a downward sloping, notice it's kinked. Okay, this kinked demand, and you can look that up in your principles of microeconomics work. Perhaps Dominic Salvatore Schaum's outline will have a quick, clean, inexpensive, by the way of doing that with Gene DiUlio. Both of them were my professors at Fordham University, both emeriti. Gene has passed, Dominic's going strong somewhere. But we have a kink demand curve, which is very interesting. And I think we have a kink demand curve because why? We have a duopsony. to, or duopoly, to buying, no, that's duopoly, to buying into the market. So we have that kink there. That's kind of interesting. Um, Forgot about that whole business of demand curves. This will be price, this will be quantity supplied and demanded. So let's put the rest of the story in. And I'm thinking this is going to be interesting. I don't know how this is going to look. It's not going to be necessarily the normal looking supply, but let's cross fingers, toes, legs, arms, the whole whatever you have available. Simulation, there we go. And it's going to be this V column. It's dinner time here in the Bronx, so you might hear some dinner time reverie next door through the window. All the windows are open. Beautiful weather. There we go. I'm going to talk my way through this. And price on the vertical axis. The ordinate and the abscissa. Okay, so it's just going to go up like this. So it is upward sloping. This is where they meet. Now, this isn't typically what you see in the textbook. It's going to go right up to about here, and then they crash together. Okay, so I suspect if we just did it to month 10, that could be interesting. And just let me play with this for a second. Instead of this, so what? This will be disjointed. 4,000 here. No. 4,000 here. And all of these have to align, kind of, so I have a feeling it's still not going to work, but you just have to bear with me. Okay. No, still doesn't work. All it does is it shows the discrepancy between the two. Now, if we had more, it would go up here, and then this would go here. Okay. The other interesting thing to note is what would happen if we had plenty, and this is the reference, we had 700. We have a excess supply. And let's see what happens there. Still the same thing going on. Okay. We have an excess supply. That didn't happen. Oh, there we go. Now we got something. Now we just have this shifting over here. Very odd looking demand curve now. Producing that. And that, look at this. This automatically drops for some reason or other and comes right back up. That's a major, major price shift. Okay. But you have a downward sloping demand curve. I don't know what that odd thing is. That's at 640. And this should be at 700. Okay. And again, they don't come together. But you can see that you can start playing with this. And this isn't exactly what you normally see in the textbook. And I think that's another thing here. Graphs and so on are very, very important. But we're building a dynamic model and then asking the question, is there a snapshot way of looking at it? And that might be with this. And we might say, for example, what if we had in the simulation, and notice what happens here. With that kind of a situation, we actually get a discounting because of the excess demand is no longer there. It's an excess supply situation. So the market is kind of flip-flopped. It's pretty interesting, I think, to play around with. So I'm going to attempt to bring this back around. Let's see. Nope, still doesn't like that. And let me go back up here to chart design. Put this in the original picture. And we know instead of 4, we really need 12. I think if I set it at probably 5,000 runs, we'd be okay. But there's that. And on the supply side, do the same thing. I just want to make sure everything is there so I don't forget when I post all of this. And there we go. And we go back to the inputs. And we have a supply reference of 600 versus 4. And what's happening here is we have different numbers occurring, so the graphs are going to change. There we go. That's more like it. We have a kink demand curve. And remember, that's WolfCo versus... Now, that's kind of interesting. Both have the same demand elasticity, yet because they're coming in at different rates of contribution to total demand, and they're interacting, it's as if they have different elasticities. And I think we can get an oligopoly theory that will support that claim. So we're actually learning something new here in our predator-prey context. Our realistic predator-prey context is creating elasticity through this process. And we're not modeling it explicitly in the price, but it's still coming out of the price. Okay. So there is a relationship that is indeed there. And that's because these things called Moose and WolfCo customer base move through time. They're different. I am also interested in seeing one more thing. Bear with me. What happens if this is 15 initial? So get rid of this seismic anomaly there. And make this 15 as well. Sloppy copying position. Okay. And let's see what the graphs say now. No, no real change. No real change. We're still at a 108. No, big change. Wow. Okay. Huge change. Yikes. A yikes change. All right. So we can break this model. There's no doubt in my mind. I set this at 150. Okay, don't let it swim around anymore. Calm things down. Evening out the market. No doubt about it. Okay, It's basically that kink is slightly downward sloped over. We have much more to think about here. Let me set this at 50. Notice how long it takes for this model to actually compute and then graph. This is more like it here. But this doesn't make much sense to me right now, nor does this. And that's because we haven't really changed that much. We can make demand a lot more sensitive. Bring it closer to unitary. And I'm not seeing any change here. I am seeing, however, yes, we do clear the markets eventually. So I'm going to leave you with this, and we'll come back one more time. But leaving with you with this is here. And thanks for your kind attention, and we'll see you on the next round.